Hello, I'm Daniel Reeves, and welcome to the Metals Thesis, a channel dedicated to real data-driven analysis of gold, silver, and the forces shaping the metals market. Here we move beyond headlines to examine structure, trends, and the logic behind price movements. If you're looking for grounded insights instead of noise, you're in the right place. Let's start today's analysis by first examining the key developments shaping the current market environment. It's Tuesday, the 24th of February. Gold reached a fresh monthly high on Monday as investors moved toward traditional safe haven assets amid a convergence of legal, political, and geopolitical developments affecting global markets. The metal rose by $117, representing an increase of 2.29%, bringing the price to $5,248 per troy ounce. The advance came as financial markets reacted to a series of events that collectively increased uncertainty surrounding policy direction, trade stability, and geopolitical conditions. The movement underscored gold's long-standing role as a protective asset during periods when institutional clarity weakens and investors seek stability. The immediate trigger for the rally was a major ruling from the United States Supreme Court concerning trade policy. The court struck down President Donald Trump's sweeping global tariffs, ruling that they were unconstitutional. According to the decision, the administration had exceeded its authority by invoking emergency powers to impose the duties. The judgment carried significant implications for fiscal planning, as revenue from those tariffs had already been incorporated into projections related to the federal deficit. Once the duties were deemed legally vulnerable, market participants reassessed the reliability of short-term expectations surrounding United States trade and budget policy. This shift in confidence contributed directly to demand for gold as investors adjusted positions in response to the ruling. The legal decision did not only affect fiscal expectations, it also introduced broader uncertainty regarding how trade measures might be structured going forward. Because the tariffs had been implemented under emergency powers, the court's ruling raised questions about the durability of similar policy tools. Investors began to evaluate whether future trade initiatives could face comparable legal challenges and whether the administration's approach to tariffs might require adjustment. In periods when the framework guiding economic policy appears unsettled, markets often respond by increasing allocations to assets that historically retain value during institutional transitions. Monday's price movement in gold reflected that dynamic clearly. President Trump responded quickly to the court's decision. On Saturday, he announced that the White House would introduce a replacement global tariff set at 15%. The measure was presented as a way to address the policy gap created by the invalidation of the earlier duties. However, the replacement tariff differs from the previous structure in important ways. It may remain in force for no more than 150 days and is limited to situations involving fundamental imbalances in international payments. While the administration described the action as part of its continuing trade agenda, financial markets focused on the legal and structural limits attached to the policy. Those restrictions signaled that the new measure might not provide the same long-term certainty as the earlier tariff framework, reinforcing the sense that trade policy remained in flux. At the same time, geopolitical developments added another layer of influence on investor sentiment. Negotiations between the United States and Iran concerning nuclear issues have reached an impasse ahead of a key meeting scheduled to take place in Geneva on Thursday. The diplomatic stalemate has unfolded alongside reports of a military buildup in the Middle East. Together, these developments contributed to a risk-averse tone across financial markets, as investors evaluated the potential implications for regional stability and international relations. When geopolitical conditions appear uncertain, investors frequently shift toward assets viewed as more stable, and this pattern was visible in Monday's trading activity. The combination of trade-related uncertainty and geopolitical tension created overlapping sources of support for gold. Markets were not responding to a single isolated development, but rather to several events occurring simultaneously. The Supreme Court ruling introduced questions about policy durability, the administration's response highlighted ongoing structural limits, and diplomatic developments in the Middle East added further uncertainty. Together, these factors strengthened the case for defensive positioning, encouraging flows into precious metals as investors sought to reduce exposure to potential volatility. Demand conditions in the physical market also contributed to the metal's strength. Buyers from China returned to trading following a week-long national holiday, bringing renewed activity to both gold and silver markets. China is one of the world's largest consumers of precious metals, and its participation often plays a meaningful role in price dynamics. The return of Chinese buyers injected fresh momentum into trading at a time when Western markets were already responding to legal and geopolitical developments. This combination of financial flows and physical demand helped sustain upward pressure on prices throughout the session. The broader environment supporting gold has also been reflected in institutional forecasts released by major financial organizations. Several large investment banks have issued projections suggesting that gold could reach $6,000 per ounce or higher in the year 2026. Among these, BMO Equity Research has projected that the metal could rise to $6,500 per ounce. The firm cited ongoing inflation risks, elevated geopolitical tension, and sustained central bank purchases as key factors influencing its outlook. Particular attention has been given to buying activity from emerging market economies that are gradually reducing their exposure to the United States dollar. According to BMO's analysts, the case for higher gold prices no longer depends primarily on expectations of aggressive easing by the Federal Reserve. Instead, they argue that structural demand has become strong enough to support prices regardless of the pace of interest rate reductions. This assessment reflects a broader shift in how institutional investors interpret the role of gold within global portfolios. Rather than being tied mainly to monetary policy cycles, the metal is increasingly viewed through the lens of long-term demand and geopolitical stability. JP Morgan has offered a similarly supportive perspective. The bank's base case scenario now places gold at $6,300 per ounce within the current cycle. It also outlined a more extreme macroeconomic scenario that could potentially push prices toward $8,000, representing one of the highest targets currently discussed among major Wall Street institutions. The presence of such projections has reinforced the perception that gold remains central to the ongoing market conversation. Silver also recorded a strong move during Monday's trading session. Futures rose by $3.43, gaining 4.06% to settle at $88 per troy ounce. The advance reflected the return of Chinese buyers as well as the same macroeconomic forces influencing gold. Silver's dual function as both a safe haven asset and an industrial commodity has kept it firmly in focus as investors assess the balance between slowing global growth and persistent supply constraints. Taken together, the legal uncertainty surrounding United States trade policy, the administration's response, renewed geopolitical strain, the return of Chinese demand, and rising institutional price projections have positioned precious metals at the center of market attention. These developments form the foundation of today's report and lead directly into a closer examination of how each factor unfolded in detail. Following the initial market reaction, attention turned more closely to how the Supreme Court ruling reshaped expectations around United States trade policy and fiscal planning. The invalidation of the global tariffs did not only remove an existing policy tool, it also altered assumptions that had already been incorporated into economic forecasts. Tariff revenues had been included in projections related to the federal deficit, and once the court declared the duties unconstitutional, those projected funds became uncertain. This shift affected how investors evaluated near-term budget stability, prompting a reassessment of policy reliability. When fiscal assumptions change suddenly, markets often respond by seeking assets perceived as insulated from institutional disruption, and the rise in gold reflected that adjustment. The legal basis of the tariffs became a central issue in market interpretation. Because the duties had been imposed through emergency powers, the court's ruling suggested that similar measures could face limitations in the future. Investors were therefore not only reacting to the immediate removal of the tariffs, but also to the broader implication that trade policy might be subject to stricter legal scrutiny going forward. This perception contributed to an environment in which the durability of policy tools appeared less certain, reinforcing demand for assets traditionally associated with stability during institutional transitions. President Trump's announcement of a replacement tariff introduced a new element into this evolving situation. By proposing a 15% global tariff, the administration signaled its intention to maintain continuity in its trade approach despite the court's decision. However, the structure of the replacement measure differed from the earlier policy. Its duration was limited to 150 days, and it could only be applied in circumstances involving fundamental imbalances in international payments. These constraints indicated that the new tariff would operate within tighter legal boundaries. Markets interpreted those limitations as evidence that the broader framework of trade policy remained unsettled, sustaining a cautious tone among investors. The response in financial markets demonstrated how closely gold trading is tied to confidence in institutional predictability. When the rules guiding economic policy appear subject to change, capital often moves toward assets viewed as less dependent on political or legal structures. Monday's price movement illustrated this relationship clearly. The combination of the court's decision and the restricted nature of the replacement tariff left traders with an incomplete picture of how trade policy might evolve. That uncertainty helped maintain demand for gold even after the initial news had been absorbed. At the same time, developments outside the legal sphere reinforced the defensive posture visible in markets. Negotiations between the United States and Iran over nuclear issues had stalled ahead of the Geneva meeting scheduled for Thursday. The diplomatic impasse coincided with reports of a military buildup in the Middle East, contributing to a broader sense of risk across global financial markets. When geopolitical developments introduce uncertainty about regional stability or international relations, investors frequently reduce exposure to risk-sensitive assets and increase allocations to those perceived as more secure. The continued rise in gold reflected that shift in positioning. The interaction between trade uncertainty and geopolitical tension created overlapping pressures that supported precious metals throughout the session. Markets were responding not to a single event, but to several developments unfolding at once. The legal challenge to tariffs raised questions about policy continuity, while the diplomatic stalemate and military activity in the Middle East added further uncertainty to the global environment. Together, these factors reinforced the appeal of safe haven assets, allowing gold's rally to extend beyond the immediate aftermath of the court's ruling. Physical demand also contributed to sustaining the upward move. Chinese buyers returned to the market after a week-long national holiday, bringing renewed participation to both gold and silver trading. Because China ranks among the world's largest consumers of precious metals, its return to active trading often exerts a noticeable influence on price dynamics. The renewed buying activity provided additional support at a moment when financial markets were already adjusting to legal and geopolitical developments. This combination of institutional flows and physical demand helped maintain momentum across the precious metals complex. The timing of this return played an important role in the strength of the rally. As Western markets focused heavily on interpreting the implications of the Supreme Court ruling and the replacement tariff proposal, the reappearance of strong physical demand ensured that the move was not driven solely by financial positioning. Instead, the rally reflected both consumption trends and investor sentiment. The presence of buyers in multiple regions contributed to price stability, allowing gold and silver to hold their gains during the session. As trading continued, a consistent narrative emerged across markets. Investors were responding to a convergence of developments that collectively increased caution. The legal uncertainty surrounding tariffs altered expectations about trade policy durability. The diplomatic impasse and military activity in the Middle East contributed to a broader sense of geopolitical risk. Meanwhile, the return of Chinese demand added tangible support from the physical market. Together, these elements created an environment in which precious metals naturally attracted increased attention. This evolving backdrop set the stage for the growing importance of institutional outlooks. Updated projections from major financial organizations increasingly reflected the same conditions influencing daily market behavior. The alignment between immediate trading dynamics and longer-term forecasts suggested that the forces supporting gold and silver were not viewed as temporary. Instead, they appeared connected to broader structural trends influencing global markets. In the next part of this report, we will examine how these institutional projections and silver's market role further shaped the narrative surrounding precious metals during this period. As the session progressed, the focus of market discussion increasingly shifted toward how major financial institutions were interpreting the environment surrounding precious metals. Updated projections from several large investment banks indicated that the forces supporting gold were being viewed not only as short-term catalysts, but also as part of a broader structural backdrop. These forecasts played an important role in shaping investor sentiment, as institutional outlooks often influence how markets interpret both immediate developments and longer-term trends. Among the organizations issuing updated expectations, BMO Equity Research presented one of the most prominent projections. The firm indicated that gold could reach $6,500 per ounce, pointing to several factors it believes are likely to remain influential. According to BMO's assessment, persistent inflation risks continue to shape investment decisions across global markets. At the same time, elevated geopolitical tensions remain a defining feature of the international environment. The firm also highlighted sustained central bank buying as a key source of structural demand, particularly from emerging market economies that are gradually reducing their exposure to the United States dollar. These elements together form the basis of BMO's outlook, reinforcing the perception that support for gold extends beyond immediate market reactions. BMO's analysts also emphasized that the case for higher gold prices does not rely solely on expectations of aggressive policy easing by the Federal Reserve. In earlier cycles, forecasts for gold often depended heavily on the prospect of significant interest rate reductions. However, the firm indicated that demand dynamics have evolved. Structural buying activity and long-term portfolio considerations are now seen as strong enough to support prices regardless of the pace of rate cuts. This interpretation reflects a shift in how some institutional investors view the role of gold, suggesting that its importance may be tied more closely to broader economic and geopolitical conditions than to short-term monetary policy changes. JP Morgan released a similarly supportive outlook, reinforcing the broader institutional narrative surrounding precious metals. The bank's base case scenario places gold at $6,300 per ounce within the current cycle. In addition to that central estimate, JP Morgan outlined a more extreme macroeconomic scenario that could potentially allow prices to approach $8,000 per ounce. This projection represents one of the highest price targets currently cited among major Wall Street institutions. The presence of such forecasts contributed to the perception that large financial organizations see the current environment as capable of sustaining elevated price levels. Institutional projections such as these do not operate independently of market activity. Instead, they interact with daily trading behavior, influencing how investors interpret developments in policy, diplomacy, and demand. When forecasts from multiple institutions point toward higher price ranges, they can reinforce the belief that underlying conditions remain supportive. In this case, the projections from BMO and JP Morgan aligned with the same combination of factors already influencing trading activity, including legal uncertainty in trade policy, geopolitical tension, and the return of strong physical demand. This alignment helped strengthen the narrative that precious metals remain central to current market positioning. Silver's performance during Monday's trading session provided an additional perspective on how these forces were affecting the broader precious metals complex. Futures for silver rose by $3.43, representing a gain of 4.06%, and settled at $88 per troy ounce. The increase was supported by many of the same drivers influencing gold, including renewed participation from Chinese buyers and the broader macroeconomic environment. However, silver's position in financial markets differs in one important respect. It serves both as a safe haven asset and as an industrial commodity. This dual role often places silver at the intersection of financial and economic signals. On one side, its safe haven characteristics link it closely to investor reactions during periods of uncertainty. On the other, its industrial uses connect it to trends in manufacturing, technology, and global production. As a result, investors frequently watch silver as an indicator of how markets are balancing expectations of economic growth against concerns about supply constraints. Monday's advance suggested that the same forces supporting gold were also encouraging demand for silver, reinforcing its position within the precious metals sector. The return of Chinese buyers played a role in both metals, providing support from the physical demand side of the market. China's importance in global precious metals consumption means that shifts in its trading activity can have meaningful effects on price behavior. The resumption of participation after the holiday period helped sustain upward pressure on prices, ensuring that the rally reflected both financial positioning and underlying consumption trends. This combination of institutional outlooks, macroeconomic developments, and physical demand created a consistent narrative across the precious metals market. As the trading session continued, the alignment between immediate events and longer-term institutional views became increasingly clear. The Supreme Court ruling had introduced legal uncertainty into trade policy. Diplomatic tensions and military developments in the Middle East had added another layer of geopolitical concern. Meanwhile, strong consumption from a major global buyer reinforced the physical demand side of the market. Together, these elements helped explain why both gold and silver held their advances, as investors weighed short-term developments alongside broader structural considerations. These developments lead directly into the concluding portion of our report. In the final part, we will bring together the key elements shaping the precious metals landscape and summarize how legal decisions, geopolitical conditions, demand trends, and institutional projections combine to place gold and silver at the center of market attention during this period. As the developments of the trading session were fully absorbed by markets, the movement in precious metals reflected the combined effect of legal decisions, policy responses, geopolitical developments, and demand conditions that together shaped investor positioning. Gold's rise to a monthly high on Monday occurred within a broader environment in which multiple sources of uncertainty emerged simultaneously. The Supreme Court's ruling against the administration's global tariffs introduced immediate questions about the stability of United States trade policy and the reliability of fiscal projections that had already incorporated expected tariff revenues. Once those revenues became legally uncertain, market participants reassessed assumptions surrounding the near-term direction of government budgeting and economic planning. This reassessment contributed to a shift toward assets historically viewed as more stable during periods of institutional transition. The administration's response added another dimension to the evolving situation. President Trump's announcement of a replacement 15% global tariff indicated an effort to maintain continuity in trade policy following the court's decision. However, the structure of the substitute measure, including its maximum duration of 150 days and its restriction to cases involving fundamental international payments imbalances, highlighted the legal boundaries within which the policy must operate. Financial markets interpreted these limitations as a sign that the longer-term framework of trade measures remained subject to institutional constraints. That perception reinforced the cautious positioning already visible in markets and helped sustain demand for gold as investors evaluated the durability of policy tools. Geopolitical developments contributed further to the environment influencing market behavior. Nuclear negotiations between the United States and Iran had reached an impasse ahead of the scheduled meeting in Geneva, while reports of a military buildup in the Middle East added to concerns about regional stability. The combination of diplomatic uncertainty and increased military activity contributed to a broader, risk-aware tone across global financial markets. When geopolitical conditions appear unsettled, investors often reduce exposure to assets perceived as more volatile and increase allocations to those viewed as protective. The continued strength in precious metals reflected this adjustment in positioning as markets processed developments across both policy and diplomatic fronts. Physical demand conditions remained an important part of the overall picture. The return of Chinese buyers to the market following a week-long national holiday provided renewed participation in both gold and silver trading. Given China's position as one of the largest consumers of precious metals globally, its re-entry into active trading supported price strength even as Western investors focused on interpreting legal and geopolitical developments. The presence of demand from both institutional investors and physical buyers helped explain why the rally held firm rather than fading after the initial reaction to the Supreme Court ruling. Institutional outlooks offered additional context to the market narrative. Several major investment banks have issued projections indicating that gold could reach $6,000 per ounce or higher in the year 2026. BMO Equity Research projected that the metal could climb to $6,500 per ounce, citing persistent inflation risks, elevated geopolitical tensions, and sustained central bank buying. Particular attention has been given to purchases by emerging market economies that are gradually reducing their exposure to the United States dollar. BMO's analysts also indicated that the case for higher gold prices does not depend primarily on aggressive easing from the Federal Reserve, noting instead that structural demand appears strong enough to support prices regardless of the pace of interest rate reductions. JP Morgan's outlook reinforced this institutional perspective. The bank's base case scenario places gold at $6,300 per ounce within the current cycle. It also outlined a more extreme macroeconomic scenario that could potentially allow prices to approach $8,000 per ounce, one of the highest projections currently cited among major Wall Street institutions. The presence of these forecasts illustrates how central precious metals have become in discussions of macroeconomic positioning as investors weigh legal developments, geopolitical conditions, and long-term demand trends. Silver's performance during Monday's trading session mirrored many of the same influences. Futures rose by $3.43, gaining 4.06% to settle at $88 per troy ounce. The advance was supported both by the return of Chinese buyers and by the same macroeconomic forces influencing gold. Silver's role as both a safe haven asset and an industrial commodity keeps it closely linked to investor expectations about global growth and supply conditions. Its participation in the rally confirmed that the forces supporting precious metals were affecting the sector broadly, rather than being limited to gold alone. Taken together, the legal uncertainty surrounding United States trade policy, the policy response from the White House, the stalled diplomatic negotiations with Iran, the reported military developments in the Middle East, the return of Chinese market participation, and the rising institutional price projections all contributed to keeping precious metals at the center of market attention. These developments explain why gold and silver moved higher and why investors continued to monitor the sector closely as the session progressed. With policy questions still present, diplomatic issues unresolved, and institutional forecasts continuing to highlight the role of precious metals in global portfolios, gold and silver remain closely watched indicators within the broader macroeconomic landscape. Their performance on Monday reflected how legal rulings, geopolitical developments, demand patterns, and institutional expectations can converge to influence market behavior. This combination of factors forms the core of today's report and concludes our coverage of the movements in precious metals during this period.